Welcome back. Let's talk consumer. Arnab, Mitra, India consumer analyst, Goldman Sachs, joins us now. We've got a slew of updates coming in from the sector. In the discretionary space, the jewelry space has been doing extremely well. And there have been mixed, updates coming in from the consumer staples space. Arnab, thank you so much for joining in. Happy 2026. It's a cheerful headline that you have for the report. Stars are aligned for the sector for multiple revenue and margin tailwinds. The question is by when? Because, the third quarter so far also saw some disruption. The fourth quarter, let's see how that goes. Is recovery shifted to the second half of next year?
Yeah, hi, Mangalam. Thanks for having me on. No, I think if you look at our outlook piece, I think we're clearly looking at a good year for FMCG. Though we are a bit cautious on consumer discretionary, and we can talk about both. I think on the FMCG side, we clearly see the tailwinds of the GST rate cut starting to have some impact right now. We are seeing moderating input costs across the board, whether it is crude, palm oil, tea, copra. We have the low base of the summer last year where the summer wasn't great. And therefore, we do expect earnings growth, which has been more like mid-single digit in the last couple of years, to accelerate to more like mid-teens. Now, to your question that when do we really start seeing this happen, it's actually here and now. In fact, in our preview for the third quarter, you would see that there are a large number of stocks that we cover where we'll for the first time see double-digit revenue growth in a long time. And in many of these companies, because of some margin expansion starting to flow through, we will also see earnings growth go towards the low to mid teens in many of these companies. So for FMCG, I think it's very much here and now. It's not a second half story. It should start showing up in the December quarter, and the momentum should build from there on as some of these tailwinds become stronger. However, on the discretionary side, Mangalam, I think it's a bit of a different story. Jewelry is clearly is a exception right now. That's one sector which is doing extremely well. But otherwise, if you look at low ticket discretionary, whether it is QSR, whether it is fashion, whether it's footwear, we are not seeing good clear reads on demand improvement. We are also seeing heightened competitive intensity in many of these segments. We are seeing digital disruption in many segments. And we are still seeing earnings downgrades, which is the biggest issue. I mean, valuations are high and earnings are still getting downgraded. So I see this year as staples or FMCG doing well, discretionary largely not doing well, with the exception of jewelry maybe as a segment. And in staples, we should see the tailwinds right away as we start off the year.
Right. I fundamentally agree with you on the topics that you've made and the kind of performance that they've reported as well, and the underlying benefits for them too. Marico, for one, you are likely to see margin expansion. Copra, is 30% off highs. TCPL, obviously, again, the worst of tea inflation is behind them. Margins are likely to expand out there. Godrej Consumer, yesterday we got the update, near double-digit volume growth, margins back in normative range. So on your top picks, yes, makes sense. But my question was more to do with, the likes of HUL, Dabur, Colgate, all of them still continue to be laggards. And there we haven't seen growth or signs of growth coming back. That's point number one. And on Varun Beverages, 9 months of extremely adverse weather. How do you mitigate that?
Yeah, I think if you look at FMCG, I think it's a rising tide which actually helps all companies. Even let's say the companies which are lagging in this quarter, you would actually see an improvement over what they would have delivered in the first half of the year. So I would say that it's like the tailwind affects everybody. The bar kind of goes up for everybody. It helps the growth everywhere. However, there are some stocks, as you know, who are doing a lot of self-help. They are expanding into new segments. There is portfolio transformation. They are playing on the new channels of quick commerce. So those companies, of course, will see faster growth as they were seeing earlier. But if you see across the board, we expect third quarter numbers to be better than the first half. Now, specifically to some of these summer categories, which where carbonated beverages, of course, is a large segment, which is very summer skewed, where there was an impact last year. We do expect an improvement. Of course, it's very hard to predict weather, but it's fair to assume to begin with that the weather will be normal after a very adverse weather last year. And that low base effect, of course, itself leads to some pickup. But as I mentioned, the macro tailwind itself does give an uplift of 2 to 4% to most companies. And then it's up to how companies execute on their portfolios to drive that differential, which has always existed.
All right, just a quick one before we let you go. We spoke to the management of United Breweries. They've extended their Kingfisher portfolio by a new launch, and they believe that this will be one of their biggest launches yet because it's their main brand. I don't know whether you track the Alcob space. What's your call here? And Trent, that's been disappointing for the last many quarters, and the stock's been underperforming as well.
Yeah, I think I won't speak about specific stocks, but on the Alcob industry in general, I think we have been positive on the industry in the past. However, there are a couple of challenges in the industry. One is there have been some tax increase related issues in specific states. There is, of course, a bit of a risk of, given the fact that GST collections have been soft this year, and whether it is central government or state government, tax collections would probably be a challenge. There is some risk of potential tax increases, which we have to be very mindful of. At this stage, I see conventional FMCG having more tailwinds than Alcob as we move into 2026. On the fashion industry in general, I would say there are two trends we are seeing. Underlying growth has not seen very good pickup, and we are seeing heightened competitive intensity. It's across the board. There is part of it which is digital, and also part of it which is deep value fashion players emerging, and then there is very high intensity within the existing fashion universe. So I think this combination of soft demand, high competition, digital disruption is something which I think players will have to navigate through.
All right, Arnab, always a pleasure speaking with you. Thank you so much for joining in and giving us your views. Obviously, we'll invite you once again, post the numbers to make sense of how they were and what the outlook is thereafter as well. With that,